Hello trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at some of the recent inflation numbers that came out higher than expected, the potential for them to move higher and how that could affect the S&P 500, the stock market in general, as well as the US dollar and US interest rate markets. But first, let's start with inflation itself. And if you're looking at it broadly, it obviously looks a lot better here in the early part of 2024 than it did in 2022, well off of the highs. And we're looking at CPI inflation, which is one of the two benchmarks here in the US, right next to PCE inflation. And they've both moved lower from those highs that we saw in 2022. And CPI quoted an inflation rate all the way up at 9% near its highs there, and we're off to 3%. But some worries, some fear is reemerging around inflation in the U.S., given that the recent print of 3.1% was actually 0.2% higher than expectations, and people wondering if the U.S. economy is going to be able to head down to that 2% target. And you can see with the historical data, inflation has really hovered around that 2%. It's gotten down into deflationary periods a couple of times in the last 2 decades, and it's also risen to 3, 4, 5%, the most recent rise being the highest in the last 20 years. And we're close to that 2%, but like I say, fear reemerging that we haven't gotten there, and we're not heading there as the Federal Reserve and economists throughout the U.S. had projected, given the most recent readings. And what's particularly problematic about this is energy inflation, which was part of the reason that we saw such a run-up in inflation in 2021 and 22, a lot of it having to do with, the pandemic hitting in 2020, the global economy warming back up at the end of 2020 and into 2021, and then the global economy, and especially in the U.S., really opening up in 21 and 22, and that brought with it a lot of price inflation and energy. You'll remember crude oil prices and natural gas prices were screaming higher. And you can see here, this is that energy sector inflation, and it got all the way up above 25% at a certain point at the peak of inflation there in the end of 21 and the start of 22. And like I say, what's particularly problematic or potentially fearful here is that energy inflation has actually entered a deflationary mode. And people, a lot of economists thought that the recent fall in prices for crude oil and natural gas would have been enough to pull the headline inflation that includes food and shelter and clothing and all these different things down to that 2% target. But if energy inflation is negative, it's deflationary right now, and our headline inflation is still not able to get to that 2% target, what could happen if energy prices resurface or we see the shelter prices that we've seen? Shelter inflation is still very, very high. If any of these pieces uptick even a little bit, we could get further away from that 2% target, which could have a bunch of downstream effects. But I bring in energy as an example here because natural gas prices and crude oil prices are historically low. Crude oil in the 70s is average for the last 20, 30 years, but given the last couple of years of trading, 60s to 70s for crude oil has really been the low. And you look at natural gas, and under $2 right now is a real historical low for multiple years going back in time. And so if natural gas and crude oil do uptick and that energy inflation gets back into inflation away from deflation, and even gets back to 2, 3, 4%, let alone the 20 to 30% that we saw at the peak inflation in recent years, that could bring that headline inflation even higher and give the Fed another reason to not cut rates. And we've seen this play out in interest rate markets as well as stock markets recently, this fear resurfacing in line with this higher inflation that we just reported here in the US. And it doesn't look like much, but the S&P 500 has turned over off of its highs, and it's toying around with that $5,000 price. The index here is, and this turn has coincided with that inflation number and this building fear that we could see a resurface from either the energy sector or the food sector or the shelter sector, like I say, has been the highest and hasn't really come down. Just sticky inflation in general could cause the Fed to not cut rates, which we saw a lot of the upside in the stock market in the end of 2023 and the start of 2024 with the idea that the Fed is going to cut interest rates at some point this year. But if inflation stays sticky, or if, knock on wood, inflation resurfaces in the US to the 4 or 5% range as it has been in recent history, the Fed might have their hands tied and not able to cut rates in 2024 as expected. This has, however, been good for the US dollar market as it's as stocks have come off. US dollar has been seen as a little bit of a flight to quality, or you could just see it as getting a renewed sense of demand if U.S. interest rates are going to stay high for longer and the Fed isn't going to cut. Then people might still want these U.S. dollars to invest at higher interest rates relative to a Japan that's at negative interest rates still, or if the Euro area or the UK or Australia or Canada, who are continuing to see lower inflation prints, if their inflation does get lower, they cut rates, but the U.S. does have higher inflation for a longer period of time, they don't cut rates. This U.S. dollar could continue to see a little bit of this flight to quality. But of course, this could just be some one-off data. Inflation could get down to that 2% target like everybody in the U.S. is hoping, and especially Fed Chair Powell is hoping in 2024 here, and they could start cutting rates. But recent inflation number definitely promoting some fear in the other direction.